Hello everyone, I am Ms. Saili Jadhav, Department of Civil Engineering. So today we are learning the topic depreciation. So the depreciation means what? A property gradually loses some value due to its wear and tear and the similar other causes. This loss in the value of the property is called depreciation. This value of building or a structure will be gradually reduced due to its use, life, wear and tear, etc. A certain percentage of the total cost may be allowed as a depreciation to determine its present value. The general annual decrease in the value of the property is known as annual depreciation. Usually, percent rate of the depreciation is equal to original cost minus amount of depreciation. Okay, so the causes of depreciation is wear and tear, physical decay, accidents, reduction in efficiency, obsolescence, etc. Okay, so this is your depreciation. Another next one topic is sinking fund. Now what is sinking fund? This comes under this valuation. So the sinking fund is an amount which has to be kept aside at a fixed interval of a time out of the gross income, so that at the end of the useful life of building the fund should be accumulate to the initial cost of the property is called as sinking fund. So the formula is I is equal to SI upon 1 plus I in the whole bracket raised to n minus 1. So the S is the amount of sinking fund, I is the rate of interval in decimal, n is the number of years required to create sinking, and I is the annual installment required. After a building is constructed, it is subjected to wear and tear and its value goes on decreasing with time. At the end of the utility period, its value becomes equal to the scrap value. Hence, some amount of fund is kept aside every year of the purpose of the reconstructing the building after its utility period is over. This amount is deposited in fixed deposits or in the government securities to obtain interest. So the calculation of sinking fund depends upon the factors, that is the life of building, rate of increasing of sinking fund, scrap value of the building. Okay. So the next one is methods of depreciation. There are methods of calculating depreciation. The first one is straight line method, then the sinking fund method, then the constant percentage method, and the fourth one is quantity survey method. So we learn in detail. First one is straight line method. So the straight line method is simplest method. The assumption of this method is that property loses its value by the same amount of every year. A fixed amount of the original cost is deducted every year, so that at the end of the utility period only the scrap value is left. That is why annual depreciation, that is D, is equal to original cost minus scrap value upon life in years, that is original value C minus scrap value S, the divided by n, that is life in years. Okay, this is the formula for calculating the straight line method for depreciation. Okay, now the next one is constant percentage method. So in this method it is assumed that the property will lose its value by constant percentage of its value at the beginning of every year. In such method, it is considered as depreciation factors, that is DI is equal to 1 minus S upon C raised to 1 upon N. So this is the formula. Now the next one is quantity survey method. So the quantity survey method is one of the most successful and widely used method which the property is studied in detail and which loss in value owing to the physical deterioration in worked out. So in this method the property is studied detailed loss and loss in value due to life, wear and tear, decay, obsolescence, etc. is worked out. Also, the amount is to be spent for more modernization, etc. So, as effect, obsolescence is worked out. Each and every step is based on some logical ground without any fixed percentage of the cost of property. Only experienced valuer can work out the amount of depreciation. Now the next one is computation of capitalized value. So these are some definitions which are used and which is very important in our valuation when we calculated that valuation of your property. So the first one is gross income. So it is the total income and includes all receipts from various sources. The outgoings and the operational and collection charges are not deducted. Second, outgoings. In general, outgoings are assumed as 30% of the gross incomes or gross rent. In detail, these are the expenses required to be incurred to maintain the revenue of the building. And then the next one is net income. So the net income is the saving or the amount left under deducting all outgoings, operations and collection charges for the gross income or total receipts. So the net income is equal to gross income minus outgoings. Then the next one is year's purchase. So it is defined as the capital sum required to be invested in order to receive an annuity of ₹100 at a certain rate of interest. So in this formula is YP, that is year purchase, is equal to 100 divided by rate of interest, or YP is equal to 1 divided by I. Okay, so this is the formula for year purchase. Now the next one is types of outgoings and their percentage. So there are various types of outgoings. First one is taxes, then repairs, then management and collection charges, sinking fund, annuity. Okay, so in taxes this includes municipal tax, property tax, wealth tax, etc., which are to be paid by the owner of the property annually. The second one is repairs. In repairs includes to maintain the property in fit condition, so it is required to carry out some repairs every year. So the construction for annual repairs, 1% to 1.5% of the total value or the cost of construction is considered. Then the management and collection charges. So these are the charges which include expenses on certain collector, that is watchman, liftman, pump room attendant, sweeper, etc. It is about 5 to 10% of the gross rent may be taken on this account. And the last one is sinking fund. A certain amount of the gross rent is kept aside, usually as a sinking fund, to accumulate the total cost of the construction when the life of a building is over. Then the next one is annuity. So annuity, it is the annual periodic payment for repayment of the capital amount invested by partly. Annual payments are there either paid at the end of the year and or at the beginning for a specified number of years. That is the annuity certain paid at each period. Annuity due means paid at beginning of the year or a period. Deferred annuity means it begins at the some date in future, and perpetuity it continues and indefinitely. So now the next one is the problems which are comes in this valuation. Okay, so here we calculate some fixed, we fix a monthly rate of the property. Okay, so the example is a building is newly constructed at the cost of construction is given, that is the 13 lakh on the plot of 900 meter square. Okay, and the given documents are the rate of land per rupees 100 per square meter, then the return expected on the cost of land and building is 8%, then the life of building is 60 years, then the scrap value is equal to 10% of the construction cost, and other outgoings, that is 30% of the gross rent. So how we calculate? The first one is the cost of land, so we calculate rate of land into the plot, that is 100 into 900, that is 90,000. Okay, then the first step to find the total net return per annum. So return expected on the cost of land including 8%, that is why 8 upon 100 into 13 lakh 90,000. Okay, total cost. So that comes so the value comes 1,11,200. Okay, how calculate? 8% into 13 lakh 90,000. Okay, so the net return is per annum 1,11,200. Okay, so in step 2 to find the expenditure on outgoing per annum. So the expenditure on outgoings per annum is outgoing, we given outgoing is 30% of the gross rent, so 0.3 into gross rent not given, that is why we are assuming gross rent as x. Okay, so gross rent is equal to, what is the formula for gross rent? Gross rent is equal to net return plus outgoings, that is why put x here, and the net return value and the outgoing, that is 0.3 into x. Okay, so calculated, therefore 0.7 into x and 1 lakh 11,200 we calculated, divided by this value, so we got the final value of x, that is gross rent value. Okay, that is your 1,58,857. Okay, now the step 3 is to find the rent per month. So the value of x, that is gross rent, is divided by 12, because that we calculate the rate per month. Okay, that is why we divided by 12. Okay, so we got the rent is 13,240. Okay, now the next one, sum is suggest the suitable rent per month of a building, which given information, that is plot area 300 meter square at 300 per meter square. Okay, and then building area construction 150 meter square at rupees 1500 per meter square. The total outgoings we have to given, that is 30% of the gross rent, and the return expected on the construction cost as 12%, and the return accepted on the cost of land is at 8%. So we calculate, step 1 is to find the cost of plot, that is 300 into 300, that is 19,000. Now the next one is the cost of construction, so we put 150 into 1500, then the cost of rent, net return. So in step 3, how we find net return? So the net return on construction, this given data we put only in that amounts. Okay, so 8%, that is 8 upon 100 into 90,000. Then the net return on plot, so we divide the 12% into 2,25,000. Then the total net return per year, so we add all the net returns. Okay, 7,200 plus 27,000, so we got all the net rent per year. Okay, that is 34,200. Now we find the total gross rent. Okay, so the annual gross rent is equal to G plus is equal to net rent plus outgoings. So gross rent, the value of gross rent we put, and 30%, so the last sum we calculate same as we put here for finding out the G, gross rent. So we got the answer is 48,857.14. so for total month, for per month we divide by 12. Okay, and we got the answer, that is 4,072. Now the next one sum is, a person purchases a plot 600 square meter at 900 per meter square. So he constructs a building having 200 meter square built up area, and the cost of construction is being rupees 700 per meter square. So he desired to have a net return 6% of the building cost and the net return of 5%. So we calculate that 5% at your building and land cost. Okay, at a percentage. Then then assuming outgoings 22% of the gross income, so suggest the property rent. So the cost of land first we calculated, then the cost of building, that is 200 into 700. Okay, then we net return calculated, that is 6% of the building of the cost, so we put the cost of building and the cost of land. Then the gross rent we calculate same as last sum in the outgoing and then the net returns. So we find out the gross rent, okay, per year, and after that we divided by 12, so we got the answer 3782. Okay, now this is the sum for year purchase. Okay, sinking fund method. So we calculate the property in the form of go downs, which fetches monthly net rent 6,000. The owner expects 10% yields. So how we calculated? We have to calculate the year purchase. So the formula is capitalized value is equal to net income into year purchase. So the net income is equal to 6,000 into 12. Okay, so because of that year, so we got 72,000, and the year purchase, the formula is 1 upon I is the capital 0.1. Okay, so 1 upon 0.1 is equal to 10. Okay, so next to find the capitalized value, so capitalized value is equal to 72,000 into 10, that is YP, so 7,20,000. So we calculate the value of the property. Now the next one sum is calculated sinking fund for JCB. The cost of JCB is 28 lakhs and the life 10 years. Rate of interest is 6% and the assumed 10% of the scrap value. So the scrap value is equal to 10 divided by 100 into that 28 lakhs. Okay, 2,80,000. So original cost minus scrap value we calculated, we got the answer is 25,20,000. Okay, and the sinking fund formula we put S into I divided by 1 plus S in bracket raised to n minus 1. So we put the value and we got the answer is 19,1187.25. So that is the annual installment of your sinking fund. Okay, So now the next one sum is work out the sinking fund installment per year for collecting the sinking fund. Okay, so same as we put that value. Okay, so 2 lakh we have to given, and total is a 50 years of the life of the building, and the interest is per annum. Okay, so amount of sinking fund what given, 2 lakh. Rate of interest, that is 4%, so we divided, that is 0.04. N is the number of years we given, that is 50 years, and the annual installment of the sinking fund is required. So we put that sinking fund formula, I is equal to S into I divided by 1 plus I raised to n minus 1. So we put all the values on that formula, so we get the answer is 1170. Okay, so this is the simplest example and simplest sums of your valuation. Here we completed our valuation chapter. Okay, thank you.